Hello, good morning. Welcome to the Brew. I'm Lex. Today, we are going to be talking about opportunities in high interest rate, low implied volatility environments. Little structured product talk today. So, this is Traders Workshop. Jason and Mark are riding along. Let's get right to the opening bell.
Yeah. Good morning, Lex.
Wow. Unbelievable. What a great day. I'm telling you.
Face-palmed.
Oh no, it's I'm so excited about this topic because I have no idea what Mark's going to say about it. This is going to be perfect.
I just want to know how long you've been practicing that intro move.
Do you see that move? I did a little reverse
The
move.
timing was impeccable.
By the way, this is my dog.
Wow.
Most people have their kids on here or something cooler. I got my dog on here. I did not buy this myself, so we're clear. This was a gift.
Looks
Yes.
good on you.
Okay. A little chilly in Chicagoland today. It's July, 17th, 18th, somewhere in that ballpark. It's I woke up this morning, it's 58 degrees. That's Fahrenheit.
It's hot here. Always hot.
That is chilly. So we're only
It's been pretty hot. I don't really want to hear it.
Yeah, it's awesome. I love it. All right, gents. Here we are, high interest rates, low implied volatility. I've been snoring over IV SPX VIX. Boy, it's a sleeper. But apparently there's an opportunity. Mark, yes.
I mean, it's been a slow summer. The market's at all-time highs, and for better or for worse, that's given me time to get thinking. And I feel like when I look at the combination of super cheap vol, super cheap, single digits XPX 30-day, I think, where it's snoozer. Historicals, implied, both sides.
Yep.
But rates are still up there. We still haven't cut rates. We're in July. 6 months ago, we were expecting rate cuts already. So we've got this super cheap vol, super high levels of indices, where if we're not at all-time highs, we're within a whisper.
Yep.
And we've got, sorry, I forget which two I said. We've got cheap vol, all-time highs, and high interest rates still. What do you do with that?
I don't know, honestly.
Buy T-bills and buy call spreads.
Yeah.
Not financial advice.
Not financial advice. Buy T-bills. Buy, what'd you say?
Call spreads or put spreads, even if you want to double down on the protection.
Okay.
But take advantage of the cheap vol. Take advantage of the high rates and the premium you can earn from a bill or a bond, and put it to work with cheap vol.
Okay, so why? Again, this is a teaching moment for you, Mark. Why would we buy T-bills in high interest rate environments? Because
so I should be more specific. I should say buy zero coupon bonds.
Okay.
So for the nominal $10,000 that you have to invest, 5% interest rates, roughly you pay $9,500 today for that. You get $10,000 at the end of it. But for that $10,000 investment, you now have $500 you can spend on options premium, cheap options premium.
Okay, so the important let's explain what a zero coupon bond means first of all. So just so people understand why this is doable.
I'm glad you're the one asking the questions, because I can see Jason sitting over there with the sleeper, stumper that he's got.
Yeah, he's got a wing zinger coming. I can tell you. I'm the setup man.
Got some scenarios for you.
I'm the setup man. That's it, Mark. So enjoy this while it lasts.
I'm no fixed income specialist, but a zero coupon bond is roughly, the idea is that you pay a discount to par today, and that bond matures to par at the end of that period.
And so what's the period typically that you like to use here?
This is not a short-term trade. This is not a 1 week or 30-day trade. 90 days even feels like on the short end, but I can, respect a quarter trade on this. Typically, you're thinking 6 months, a year. I like this at a year, basically, would be my default.
So if it's a 5% zero coupon, that means you're paying that amount less for full par. So you pay $9,500 for a $10,000 expiration maturity value. Is that right?
And assuming the U.S. government is still good for it, you get your $10,000 at the end of the time.
Right. Okay. So the thought here is you got an extra $500 to play with,
mm-hmm.
and you're gonna do something with that.
Right.
Okay.
And so because that matures to that $10,000, your principal is protected. You put in 10 grand to this whole package, and you get 10 grand back out.
Right. But you're only paying $9,500 for it, which is cool.
Because you put the other 500 into the options market.
Correct. Okay. So you put the other 500 in the options market, and what do you do with it? You said call spreads, put spreads. Do you have to have a directional bias or not?
I think the very vanilla standard, structured product like of this setup is to buy a call or call spread, because that gives you protect and participate. It gives you protection on the downside. You're guaranteed that principal amount back, and it gives you some participation on the upside. I like spreads because they obviously cheapen that quite a bit, right? You can, buying the naked at the money call or whatnot is going to be expensive, but you can use spreads to say, I'll participate in the first 8% of the move, or I'll participate in moves from 10% to 25%. As strike will allow, you can do whatever you want with this.
So, okay. So what if you don't have a directional bias? You don't know. Let's say you pretend, I have no idea if it's going up or down. Do you buy a double call put kind of deal where you do a call spread and a put spread? Or how do you take advantage of, I have no idea which way it's going to go up or down, but I'm not sure.
You say you have the easy questions, but that's definitely not something I thought of with this, is like buying a straddle. First time I've thought of using but no, yeah, seriously, you could buy condors. You could, anything with a debit structure.
Sure.
Broken wing butterflies,
Could you do an iron butterfly where it's the long version of it, where you buy the straddle, sell the wings? It costs you something, right?
Yep.
Assuming it's less than the $500, which it probably should be. Is that a play? Because that way you benefit either way, right?
Yeah, there you're just saying vol's cheap, I'm getting long vol, rather than using that cheap vol to buy a directional spread.
Okay.
So yeah, that's a very interesting and clever way of using it.
Okay. Jason, hi, how are you?
Hi.
Mr. LA. Look at Hollywood over there. Just getting back from Hollywood.
Came back from Hollywood, where the men are homeless and the women are also homeless.
And the internet sucks. I know that for a fact.
That's true.
Just ask Max. You have a couple zinger dingers here for Mark.
I don't have zingers.
All right.
But essentially what I'm saying is, well, so why are we coupling the zero coupon bond with option spreads? I mean, you're getting that $500 regardless. Is that something, or, because zero coupon bonds are basically like CDs almost, right? You get like you lock up your money for a certain amount, and then you get like a percentage at the end of the day, right? At the end of the term.
I don't think, I think what you're highlighting is that like, this isn't like free money. You're basically trading your guaranteed interest for like the options exposure. And so like, there's a reason they're paying 5%, on a bond or CD of that period, is because that's the, risk-free rate or whatever that, the prevailing rate in the market. So like, yeah, that's opportunity cost there for sure. So like the game is basically like right now on the SPX, for example, what your trade-off is you say, for every, for a one lot in SPX right now, so that you have to put up 56 grand, $130 or whatever right now. Like for a one lot in SPX, you can buy a call spread that lets you participate in the first 8% of the market roughly.
Mm-hmm.
Yeah.
So you're trading 5% interest for participation in up to 8% of the market. But you're guaranteed protected, right? So like the market goes up its average amount, you make that or more, and you make that average amount, but you're guaranteed to at least get your money back, and you've traded that interest away for it.
Mm-hmm. So the worst case scenario, right? You're not gonna, unless the government fails. Okay, let's assume that's not gonna happen. You get your $500 or your 5%, I should say. And the worst case is what? You lose your debit in this call spread, whatever that is. And we don't know a percentage because we don't know the price yet. Right?
Correct.
And my
I've
guess,
actually got a fun little tool if you want, if I can share my screen and we can play around with some real numbers.
let's go to the tool, and I hope they don't highlight one of us. I hope it's just the tool. Oh, good. Thank God. Whew, I was worried about that.
That would have been funny, Lex.
That would have been funny. Okay, Mark, what do we got here? Structured products.
So
what is a structured product?
I'm not known for my interface design, but I think the logic works.
I like
structured. Mark, wait. Alexa asked what a structured product
what is a structured product? Because they actually do trade these, as a unit. Not, they're kind of off exchange, I suppose, but you could actually trade a structured product. I'm kind of fascinated with this. I have an old colleague who has a big structured product business, and it would be great if this were like listed somehow or easily listed.
Yeah, I totally agree. So structured products is a very broad name or broad category of like a financial product.
Right.
And I think I would define it as, a single investment into something that has a collection of derivatives and, things that will give you a defined outcome based on given scenarios.
Right.
So unlike, buying SPY or, the equity, it's going to go up and down and it's going to be based on supply, demand, market, forecasts, yada, yada.
Yep.
The structured product says you get paid X if Y happens. And it's usually linked to an equity index, a currency, something like that.
Yep.
But they're, I think, best categorized by their like defined outcome,
right.
structure.
Okay, good. I like those. Okay, go ahead with your chart.
And the way they're typically traded just as like a, banks are typically the issuers of these. So these aren't necessarily like products that are listed on an exchange, the way we think of like an exchange traded product or like a ETF.
Right.
That like a structured product typically has an issuer that is JP Morgan, Barclays, a big bank. And they are sort of traded, but usually they're pretty laden with fees to the issuer, who basically, collects a decent percentage to hedge out your directional risk on gold, the yen, whatever it might be.
Okay, got it. So what do you have set up here? Tell us about this.
But what we can do in listed equity options is recreate this sort of defined outcome scenario. And so like that's sort of that structure that I was describing before, is that you have this defined outcome where you're guaranteed to get back your principal with a participation based on a certain, performance in the underlying index.
Okay.
So what this sets up is this, I call it the owl, of course, because I like my birds, but this is basically a zero coupon plus a spread. And you can set up the ticker, the days to expiration. It figures out what the actual expiration closest to your target is. You can have it, you can do call or put spreads.
Yep.
And then here I have the notional amount as like a one lot of SPY, because that's sort of what you're trading off here. Like, do I want to buy 100 lot of the index or the ETF, or do I want to, put that capital into this defined outcome setup?
Okay. Got it.
Protection level, you can trade that off. So that's actually like another tweak to this whole setup, is that you can only guarantee yourself 95% of principal and take even more and buy more call spreads.
Right. Got it.
You could even guarantee slightly more, and buy less, if you wanted a marginal interest rate return on the other side.
Got it.
But what this is found right now, currently the pricing is that, 51 grand is worth $2,500 in interest at the annualized rate of 5%. You can buy a one lot of a $24 option spread, which lets you participate in SPY from 560 to 605, which is, you get $60 back left over. So you're guaranteed to make at least $60 on this. So participate in $60 to up to 7.8%.
Okay.
And you're trading off your interest today. You're trading off 5% for participation and up to 8% if the market goes up more than 8%.
Okay. So does it list the strikes that you'd use to do this spread or not? I'm just looking quickly through here.
Yeah. So you're from 561 to 605.
Okay. Right? So that's the strikes. You'd buy the 560, sell the 605?
Bingo. And that costs $24 right now, or 24.
I got you. Okay. Perfect. Okay. Got it. So,
I'm not advocating that. This is obviously not financial advice, but that when you have low rates and cheap vol, like that puts your money a lot further. And you get protection if you think the market's going to go down, and you get a little bit of participation if the rally continues.
Right. And where's the current level of SPY right now on there? I mean, I don't have it.
561.30 is money.
Gotcha. Now I get it. Okay. Awesome. Interesting. What's the terms?
So this would go to June 30th next year.
Oh, so it's a full, it's a full year deal because you have the year on the the interest rate product, right?
Yep, exactly.
Okay,
So the risk-free rate right now on a T-bill is 5.0.
This as an investor, it's good. I mean, it's not a trading tool, right? If interest rates do something dramatic, you're not going to benefit one way or another, right? Or get hurt.
You might get a mark, like there could be mark volatility.
Yep.
You might be able to like trade out early, right? Like if rates do get cut or cut more dramatically, like that coupon bond will like rise to par more quickly.
Sure.
So there could be like an early trade out there.
Right. And knowing your max gain and max loss, if some part of that max gain comes early with sooner than a year, you may have a metric for exiting that says, hey, if I get 70% of max loss within X number of days, I'm out. Get me out.
Yeah. I mean, given the long duration of these, like that's probably not going to happen until at least the 6-month mark, unless we like really rip or something like that.
Got it. Okay, cool. Jason, any thoughts here? I mean,
oh yeah, I got a couple of more basic questions.
Okay, go.
How do I get a zero coupon bond?
Walmart. They have them at the Walmart.
Lex, can you trade zero coupon bonds on Tradier?
No, you cannot.
No.
Sorry.
Listen, details.
You can actually look up on treasury.gov. You can look up what the QSIPs of them are. And I know this is a leading question because I know Jason knows that site 10 times better than I do. But like you can find what the current like on the runs are for any of those coupon bonds. And depending on a broker, like you can just purchase them directly there. And they're live tradable. So it's not like a CD where you're locked up, that like these things do trade, relatively liquidly.
Yeah. So I guess my next question is, in order to do this, you need to have a broker that recognizes your zero coupon bond, right? And also gives you portfolio margin because your money is locked up in the zero coupon bond. But if you're doing a call spread, they're not going to recognize the $500 interest until you receive it, right?
Well, you wouldn't be. That's why you do a zero coupon, because you come to the table with $10,000, put $9,500 towards the bond and $500 towards the
trade.
The trade.
Yeah.
Mm-hmm. Okay, but you would still need to come with $10,000 to the table. You couldn't come with $9,500 and then spend.
Correct. If you come with $9,500,
then
you can only spend $300 on, or $480 on. Yeah, call spreads. Yeah, exactly.
Right. So I guess that's where I'm coming at this. Like from a practical standpoint, how can you manage this in your portfolio? If you go to treasury.gov, then you have to have it shipped to your broker, right? Your custodian.
Yes. Well, doesn't treasury.gov allow you to open an account and purchase bonds directly there?
Well, right. But then you can't do the call spread on treasurydirect.gov, right?
But you just move the difference in money, right? Like you put your $500 in your broker and your $9,500 at treasury.gov.
Right. So I guess I'm just talking about this from a practical standpoint. So then you could use Tradier for all the options part of the for the options part of the trade, and then so Tradier gets the $500 and treasury.gov gets $9,500.
That's probably how it has to be.
Yeah, government always takes more, right?
Feels that way.
Although start doing some of these condors, you got all kinds of legs coming through Tradier, especially if you're adjusting this.
There you go. Now you're talking. Let's trade options. I love it.
Yeah,
so
I'm just thinking from a practical standpoint.
Yeah, I was going to say from a practical standpoint, it's probably tough for the average retail trader to throw this on. Right. But Mark, what about? I mean, you might have said this just now, Jason. Can we use an ETF that's just a listed product of sorts to kind of give us a facsimile here on the bond side?
I got to think about that. To my understanding, most of the bond ETFs are just funds that they manage with target dates and stuff like that.
Okay.
It doesn't like to get this effect, you truly need something that's like exactly your expiration or
okay. Got it. Interesting. Okay. Excellent. So I like the concept though. Makes sense for sure.
Well, there's just so much you can do with it. I mean, like you can play with 5% interest in a lot of ways, I think is the main point. Like Lex wants to buy condors. I'm probably more of a vanilla call spread guy.
Yeah.
But yeah.
Yeah. I love this iron butterfly thing. I mean, that's my favorite because and you could actually use it with this thing very easily.
Oh yeah. And I mean that's arguably you do it a shorter term.
Yeah. What did you say, Jason? Sorry.
I said I have an iron butterfly on right now.
For a 0 DTE?
No.
Oh, gotcha. All right. Excellent. All right. Well, good. I like this. This is cool. Maybe someday we get these structured kind of products all as a package one day listed. That'd be kind of fun.
Oh, a lot of them. I mean, there's some like closed-end funds that do structured products all the time.
Yeah.
You kind of have to look them up, and they're not that liquid, but
okay.
But they're out there.
Getting this is probably a little teaser for Jason's topic for next week, but there definitely are ETFs listed that have defined outcomes and structured product like setups, buffer protection, a lot of the structured products that are sold like by banks have all kinds of crazy knock-ins and best of worst of baskets, and that's hard to replicate with listed options or Bermuda style. Like if touched kind of stuff is you can't necessarily do, but all the buffering and protection and participation, like it's a bunch of spreads. And so yeah, there's boomer candy coming up next week.
Boomer candy, I love it. All right, boys, we got to run. That's interesting. A good topic today. We'll all be here next week, I think. I think we're all in town, so that's good. Still getting the summer doldrums with the single-digit implied volatilities. I kind of like to not touch it when it's this low. I don't know. The only thing I can do is some iron butterflies and iron condors, but the other way a little bit. I get nervous when implied volatility is low.
Someone's touching it though. I mean, like OCC's doing 60, 50 some odd million. Like there's real volume happening from Sleepy July.
Yeah, no kidding. It's these moves are gigantic, and yet implied vol stays low, right?
It's OPEX rotation right now, but there's a lot of like hedging and stuff like that going on in OPEX. That's what we're seeing in Voland, but a lot of call sales.
A lot of call sales. I could see that. I'm still shaking my head at how high this market is. I'm like, I have to do something.
Yeah.
Let me ask you a question, bro, before we go. So if I sell let's just say an SPX call spread that's deeper in the money. Okay. So it's already, let's say it's a $5 spread. Okay. And I sell it for $5 just because I think the market's going to go down that far and I get a freebie. Is there a margin for that? For a retail trader? I was thinking, they usually measure.
If you sell it in the money call spread,
it's you can't be exercised or assigned early. It's European. I have no risk in the trade. It's a $5 call spread. I'm selling for $5, so I can't lose anything. I can only make $5, right? Less my commission.
Good luck finding that.
I wonder if I know, right? I wonder if I could do infinity.
Yeah, I guess technically you could, but good luck finding it.
Yeah, well, they're priced there. You can't trade them. They won't trade there.
Right.
Price there.
You need to keep the money in the account though. Still.
Correct.
Expiration. So that's the margin, right? You collected $5, and the worst you could lose is $5.
No, the worst I could lose is
$0.
zero.
Worst you can lose is zero.
I'm selling it for $5.
He's selling a call spread deep in the money.
Yeah.
For $5. It's the same as like buying a put spread for zero.
Right. You got it for zero. Yeah.
Yeah. You can't. But good luck finding that.
Well, I know. I was looking at them the other day. I'm like, God, if I had a 0 DTE call spread that's the day it's expiring, like yesterday, I think the SPOOs were down 70 or a couple of days ago, whenever it was. And it opens up unchanged, but I did it the night before, and it's way deep in there, and way deep could be 40 points, and it went down 70. I hit a home run there. And I don't know if I might have to get it for $4.95 or something like that. I have to sell it for $4.95. So yeah, I got a nickel n number of times, but a nickel's a nickel. My God.
Yeah.
And you're most likely going to lose a nickel a lot.
Yeah. I was about to say, you're going to bleed slowly and surely until that one home run.
Yeah.
Why wouldn't you just try and bait nickel put spreads and try, don't you think there's probably more likely a systematic, seller of nickel put spreads than there's a buyer of
it's the same thing. Absolutely. I think you do better off on the smaller priced options anyhow.
Just even though it's obviously
and more liquid.
Like
would be more liquid.
People want to sell that nickel more than they want to buy it.
Right. Okay. Just a
Yeah.
thought. It has nothing to do with structured.
It's also
products.
more liquid.
Yeah.
Liquid with puts, right?
Yeah, it's my structured pay for the summer move. So
Your structured pay
You're
for the
just throwing
summer is to
nickels into a
spend
fountain.
$5 on
Yeah.
long shots.
yeah, doing. I love that. I love the long shots. Yeah, that's me. All right, boys, we got to go. Good to see you. Have a great weekend. And we will talk next week, Thursday, 9 o'clock Central, 10 o'clock Eastern. HarvestedFinancial.com for Mark, vol.land for Jason. We are the hub.tradier.com. Have a great weekend and
Happy trading.
happy trading.
Happy
Thank you.
Happy birthday, Volland.
Happy birthday, Volland.
Happy birthday.
Bye.
That's today.
Good.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.